very much for joining us. I'm Nico Ascari, digital markets correspondent at the Financial Times. And I'm joined here by a wonderful panel where we'll be discussing whether financial institutions are finally adopting crypto. I'm joined by Manuel Nordesta from Fidelity Investments, Christopher Seedentort from Uphold, Anya Nova from GK8, and Eliza Ndinga from 21 Shares. So thank you all. I mean, we are having this conversation about whether financial institutions are adopting crypto over the past few days where the price of Bitcoin has jumped to 35,000 or touched it. And I guess there might be a few people from traditional finance in the audience wondering whether they should have got into crypto or been trading. And I'm interested in where you sit along the spectrum and how you think about crypto. I'm talking about the asset class, I'm talking about Bitcoin, Ethereum, and we can get onto tokenization later, but you know, the pure crypto asset class, what do you do in this space? Manuel?
Yeah, happy to start, and thanks for the warm welcome. So Fidelity Digital Assets is a subsidiary of Fidelity Investments. Fidelity Investments, obviously, very, very large asset manager, mostly known as an asset manager, but it's a pretty large financial services firm. Fidelity Digital Assets does custody and execution for crypto assets such as Bitcoin and Ether. We've been live since 2018, and so probably the first kind of large financial service institution in this space. And so we've seen, it's been interesting to be in this space for a while and kind of see the various cycles, right? And I think we have a strong belief in the long-term proposition of the asset class and of what the technology enables and the business models that it enables. So, we certainly continue to invest in this business with the view that, perhaps even though we have very volatile and very sort of extreme cycles in this asset class, that there's an upwards trajectory in terms of adoption.
Anya, how about you?
Hello, my name is Anya. I'm with GK8. So at GK8, we help banks, protocols, exchanges, funds manage their digital assets, whether it's Bitcoin or Ethereum or many other asset classes. And using GK8 software, our clients are able to safely store funds, transfer funds without the risk of getting hacked, interact with any DeFi protocol that's out there through an MMI integration, or do things like launch stablecoins, or tokenized real-world assets. So we're not a custodian. We offer technology that allows customers to maintain their own private keys, because we believe enterprise customers need to control their private key at all times, and to be able to manage, store digital assets in a highly secure, unreachable way. And the history of the company is actually quite interesting. It got started by cybersecurity experts who hacked into a really well-known wallet in just a matter of days, and realized that what's on the market right now is just nowhere near secure enough to for banks or protocols or exchanges and funds to get into this space. So that's how the company was born, and over the last several years it grew into an enterprise-grade solution with a governance layer on top of that. And earlier this year we got acquired by Galaxy, which is a well-respected, publicly listed company in the space that does asset management, global trading and infrastructure. So we have a number of strategic initiatives with them. They're a large customer of ours, and at this point we're securing billions of dollars worth of assets through our combination of our deep cold vault, warm wallet, and a cash box, which is a unique innovation that we offer. So that's kind of the summary of who we are.
Very helpful, thank you. Christopher.
Yeah, hi, thank you. My name is Christopher. I run the institutional sales efforts at Uphold. Uphold's been around for 9 years, which in crypto time is a long time. And we initially focused on retail customers, but just like the industry is evolving and pivoting towards institutional clients, we've now rolled out an OTC trading desk for institutions, and we provide fundamental research. We're really focusing on altcoins, so we're trying to provide education and execution, which I think is really important in this space. When it comes to identifying tokens, we identify them early, we look for utility, and liquidity, which I'm sure we're going to discuss a little bit more later in detail, is key. When we're hoping for institutions to enter this space, I think the main two pivotal points are liquidity and security, and I look forward to the discussions later on.
And Eliza.
Sure. So I run the research department at 21 Shares. We are the world's largest ETP issuer for crypto assets. We have about $1 billion in assets under management. And for us, education is key before entering into the asset class. And that's why when we talk about education and fundamental research, it's really music to our ears because we really want to enable and building a bridge into the asset class. We also have 21.co, which is our parent company, our blockchain business, where essentially we have the platform to tokenize assets as well. And this is really trying to build a bridge into the asset class as well from a technological perspective. So we're super excited to be here.
When we think about trading and investing in crypto, Eliza, I'm interested in, well, you've got large financial institutions, for example, a lot of large asset managers, pension funds that are very wary of the asset class, whether it be regulation or otherwise reasons. But on the flip side, there are people who, traditional financial institutions who are getting into crypto. What do they look like? Where are they from? Who are those institutions that are getting into crypto at the moment? And what sort of client base do you have, Eliza?
Yeah, no, it's a great question. I think there's a variety of multiple investors that we deal with, like family offices, private banks, high net worth individuals, prop funds. So it's very diversified. I think when you look at the S-curve of the adoption cycle for crypto assets, we're still very early. Today, for example, the combined amount of ETPs compared to the total market cap of crypto assets is less than, I believe, 20%. So it shows again how early is the asset class, and most of the investors are based also in Europe because we service the European markets, in Switzerland, in Germany, France, etc. But I would say for the laggards like the insurance companies, the sovereign wealth funds, they're not there yet, and that's normal because of course the asset class has to mature. They have to understand how they can categorize the asset class compared to over equities or fixed income. So there is a lot of education to happen before we get there. But we're seeing a lot of interest for education. And I think despite the fact that we had, or we still have, a bear market, we got, like, depending on how you're looking at this, we know that education is really at an all-time high to better understand the asset class from a fundamental perspective.
Manuel, you've been doing this for a long time at Fidelity, or Fidelity has been doing this for a long time.
Me too.
Yes. The investors, the clients that you service, what do they look like? What sort of spectrum are they on?
Yeah, it's a pretty wide range. A little bit like what Eliza was saying. One thing that have noticed, however, is the profile is changing. This is a market that, unlike traditional markets, started a little bit like a retail movement, right, post the GFC. And you've kind of seen the inverse curve that you normally have in terms of adoption. And so you've seen, a few years ago, it was largely retail and high net worth individuals. The high net worth individuals, some of them that have family offices, then started bringing them family offices. The family offices that then invested, the hedge funds started bringing in their hedge funds. And I think that's kind of the adoption curve. And I think you're starting to see some of that transpire into those large allocators, such as the traditional asset managers, the pensions. And it makes sense, right? I think those guys have been, they've not been on the sidelines. They've been investing through private equity, through VC, through some of the public companies, right? And so they, some of them have public sort of positions in some of those companies, but it's much harder to choose an equity investment that's going to be the winner of a particular, set of functionality in this space than to invest in the infrastructure itself. And so I think, to Eliza's point, like, certainly the infrastructure needs to mature, right? People quote, a number of reasons. Volatility is one of them, but regulation is another one. Security, operational risk. Like, there's a lot of stuff that I think we need to figure out. And frankly, like, valuation is, very few people have, again, educated themselves well enough to have pricing models around Bitcoin, around ETH, let alone sort of the long tail of assets. And so there's some things that, and that's what institutions do, by the way. They should bring their clients kind of portfolio construction tools and modeling and that sort of thing. So I think as those things slot into place, the investment thesis around, okay, we think this technology is, has explosive growth potential, and instead of investing in individual companies, we want to invest. Like, I think that's something that we hear a lot. And so I think it's kind of a matter of time, and it's going to go through that kind of, ticking chain of demand as people demand their pension managers, their insurance companies, etc., to have a position because they can't, because it's going to become untenable not to be in it rather than too dangerous to be in it, which I think is still where we kind of are now for some of those investors.
And you're on the infrastructure technology side, like what sort of clients have been asking for your services, using your services? Have you seen it, like Manuel said, a change in that demographic over the past 12 months, 18 months?
Yeah, we definitely seen banks wanting to get into offering digital assets more. And I think what's been stopping them is just not having the fundamentals and trying to figure out how do we actually offer digital assets to clients in a secure way? Because the last thing a bank wants to do is to write a letter to the shareholders saying, "Oh, our entire treasury has been hacked," or "We lost all of clients' funds." So that's obviously we're getting a lot of interest, inbound interest, asking, well, how exactly do I secure the assets, transact them in a entirely cold way? Because a lot of the solutions that are out there on the market might call themselves cold, but they're not. They actually become hot at one point or another. So at GK8, we offer a completely unreachable cold vault that has no digital inputs, not internet connected. So we don't reduce the cybersecurity risk, we completely eliminate that. And another component that comes with that, because of this innovation, we've been able to partner with insurance companies that insure our clients for up to $1 billion per cold vault. So it's not pooled insurance, which is obviously another important component, and that's the highest insurance on the market. And then everyone needs a warm wallet for high frequency automated transactions. And I think the warm wallets out on the market right now, as you probably know, use MPC technology, which stands for multi-party computation, where the private key is split into 3 shards. And I just don't think that's sufficient, because a hacker only needs to compromise 3 internet-connected devices or 3 cloud instances to attack the funds. So, and we already seen that happen before. So Liquid Exchange lost $100 million to an MPC hack. So we think that MPC algorithms that split the key into many more parts, like a GK, we have dozens of shards, is probably the future, where it makes it exponentially harder for a hacker to get access to those dozens of computers, and makes it nearly impossible or impossible to attack those funds.
Christopher, I'm interested on the altcoin side, what sort of clients you have, what sort of interest you have on that?
Thanks, Nico. I mean, we're more focusing on the crypto native funds and the ones that have been active in the space and the ones that can trade. So large asset managers do not fall into our scope until clear regulation is in place. But I think the key point for us is to provide education in that space and navigate that space, and at the same time, as I mentioned before, provide liquidity, because it's Bitcoin and ETH are well flagged, and many panelists, even on the conference here today, will focus on the two majors. But then, what are the other blockchains trying to solve? What is their use case? And that's where we're shedding some light into that topic. But at the same time, Bitcoin and ETH I would regard as more or less liquid, maybe not even liquid enough for institutional adoption, but the most liquid. But then you come into a tail end, or even the mid-range of altcoins, where you struggle with liquidity. And the service that we focus on there is the service as a liquidity aggregator. So we're not an exchange and we're not a custodian. And I think it's important that if we expect institutions to come into the space, that we have service providers that each focus on a key problem that they're trying to solve. We combine liquidity across centralized and decentralized venues, and therefore are able to price these altcoins quite aggressively. But I just want to emphasize the point. The first step is to highlight these tokens, because, statistics vary. There's 20,000 tokens out there. I think being able to identify which ones have utility and which ones don't is very valuable. So it's the research that we focus on.
It's interesting you say that, because research is important, and highlighting those tokens, yeah, I understand that. But if you're a traditional financial institution, an asset manager, wondering, how do I even start? Where do I even start? What are the barriers for them that they need to overcome to even get to that place? Yeah,
no, I think that's a very good point. And being at a conference, when Bitcoin is up 10% on the week and everyone's super bullish and everyone knows the space, we have to remind ourselves that there's a world out there where people may have heard of Bitcoin, but that's probably it. So I think the points have been flagged in in academia and in research that adding digital assets to your bond and equity portfolio is hugely beneficial. So from a diversification aspect, it makes absolute sense to invest in this asset class. But how do you do that? And it's great. We got 21 on the panel today because ETPs is a wrapper that institutions are familiar with. And for them to add that then to their portfolios is an easy barrier. There's no barrier to entry from that point.
Yeah, Eliza, on the ETPs, I mean, when you get a new client, new customer coming to you, what are the questions that they're asking? What are the barriers that they see in getting into this space?
There is a lot of questions about what are crypto assets. Are they actually currencies? Are they assets? Are they platforms? So at 21 Shares, we really try to answer these basic questions, which is, number one, what are crypto assets? So what we did is coming up with a global classification standard called GCCS, very similar to GICS from Standard & Poor's in the late 1990s, so that the investors can see the differences between Bitcoin, Ethereum, and the long tail, and look at how they can be categorized the same way we have financials, military, and other sectors in the stock market. We have the same as well with crypto assets. When we look at just the top 10 by market cap, actually a lot of them are just a bunch of different blockchains trying to become the next app stores for the next generation of the internet services. So to answer this basic question, we actually launched the global classification standard with CoinGecko, one of the largest price providers in crypto. And then the second question that we get a lot is, how do I value crypto assets? Do they have intrinsic value? Can we find intrinsic value and measure it with Bitcoin or Ethereum or any other long tail assets? And it really comes from the classification. And then how do you compare these valuation models with, for example, a discounted cash flow method for Ethereum because there is revenue, or the cost of production for Bitcoin, because we can see that with the miners that's an activity that creates revenue for the miners. So there is a way to actually measure intrinsic value for digital assets. And then the third question is, how do I actually diversify in my portfolio? Does that falls under alternative assets? What would be the ideal percentage of my allocation? Is it 5%? Is it 1%? How often should I rebalance? On a daily basis, monthly basis, etc. So we do provide valuation models, portfolio allocation protocols as well at 21 Shares, and of course our classification standard to really help them get from 0 to 1 in the asset class.
Anya, you mentioned hacks and you mentioned the issue of cybersecurity, which is obviously critical in this industry. What sort of questions and concerns do you see from new players that are worried about that? They don't want to be on the FT front page because they've been hacked.
Well, exactly, yeah. So they want that deep cold functionality where the assets are entirely unreachable, but they also don't want to have their assets someplace remote where they have to travel to be able to sign offline transactions. They want to have instant access to those assets, which is something that we provide as well. They want to be able to rebalance assets easily and automatically between the cold storage and the warm wallet. And they want to have a governance layer on top of that, which is like a policy engine, where they can easily track their users, add users, assign them to different functions, roles, meaning that no transaction or funds can't be transacted by mistake. You can't send a transaction without the relevant approvers or to their own address. So we find that banks especially really care about that policy engine, the governance layer, and they want it to be something that they're used to. So something that they currently use for traditional assets. So for example, integration with Active Directory, which is what banks do use in order to add users or remove users. They want policies that don't have any conflicts in that. They want daily limits, weekly limits. They want different policies and different approval flows for different assets types. It just all comes down to, you can't just have custody. You can't just have a warm wallet. You need to have a full package that a bank or an exchange or a protocol or fund can adopt.
Yeah, on the full package, Manuel, how do you answer that
I
whole spectrum
I was actually
of
going to jump in if you hadn't. Yeah, no, I think I entirely agree. The custody in this space is something that because in the traditional finance space, custody is largely commoditized, right? If you're able to custody a security, it basically means you've got a books and records system, you've got some taxation reporting on top of it. But it's something that any custodian, and there's only, by the way, there's only a handful of really like global custodians in the world. And I imagine, I haven't worked in that space for a while, but I imagine their pricing schedules are more or less kind of the same across the world. That's not, and it shouldn't be the case in digital assets yet. The reason being, all the reasons that Anya just listed, right? Like custody is a game that really, at the moment at least, it only really works at scale. Like you should have globally distributed, no single point of failure for sure, but globally distributed multi-signature type solutions. Ideally you need an organization of a few hundred to really make sure that you have the right segregation of duties, the right levels of approvals, and so on and so forth. So it goes beyond the technology, it goes into kind of a deep control expertise that frankly, a fintech normally doesn't have the scale to build out. And hence I think this need for specialization which Christopher was touching on, right? I think is something that crypto is just coming into now, because we thought you could do everything in these sort of vertically integrated monsters of risk, right? Where, you're onboarding clients, you're matching up liquidity, you're clearing that liquidity, you're doing margin lending, you're doing custody. And all of these small sets of problems, even if there is no ill intention or sort of any fraudulent behavior involved, all of those are pretty big jobs, right? And there's specialization there. So I think, it'll be important to see, we're starting to see that already. To Anya's point, one of the things that we're working on also is making sure that clients can, if they're on our platform and the safety of our platform, then they're then able to connect to external venues to go and trade or to go and get loans, etc. So there's certainly a trend there. And we're seeing this kind of popping up all over the place. We're starting to see the market organically doing that. And then it's very possible, and we're seeing some starts of this in some jurisdictions, that regulators are just going to enforce it, right? That we've been kind of at it for a while. I think the regulators are going to come in at some point and start enforcing some of these principles that have been sort of transferred over from traditional finance.
It's good that you touched on regulation, because I think that's the one area that we need to touch on. That is really, or the lack of regulation is really the hindrance for a lot of large financial institutions into getting into this, because they don't know where the guardrails are. They don't want to be stepped on or caught out by the SEC, for example. How should they navigate that? How do you navigate that, for example, Manuel?
Yeah, it's a hugely complex space, right? Globally, you have a pretty difficult sort of puzzle that you're trying to put together if you want to operate globally, between, to your point, in the US, but at the moment in Europe we still don't have harmonized regulation either. So Europe as a moment is a collection of UK plus then 27 different versions of similar AML directives, and so it's and then in Asia again, like quite a mix of different regulations. So it's hard. The way that we approach it is always with clients and commercial principles in mind. And obviously making sure that we're always compliant, right? But we, at the moment, it's difficult to kind of say that you service the entire world. We look at it simply from a client demand, right? And whether it's feasible and commercially reasonable to do it. And that's really how we approach it. So if there's a country where there's a lot of demand, we have a lot of clients asking us for our services, we would typically go and do a legal analysis, and then as required, go and get licensing and that kind of thing. But it's pretty piecemeal, I would say, at this point. So we're very much looking forward, in Europe, for example, very much looking forward to MiCA, right? And having that harmonization across the block of 27. Also, frankly, some of those investor protection and sort of market safety principles that it brings, if you're a well-run custodian or venue, then you're doing them anyway. And so in our case, sometimes we spend a lot of time and effort and money doing things correctly, but the regulation doesn't give us that stamp of approval. So I think it's important to level the playing field as well.
I guess the risk is historically there have been some venues or companies that haven't been, as you said, doing it in the right way, which sort of plays into the fears that I guess a lot of asset managers, financial institutions have. Anya, how do you help navigate the regulation, lack of regulation, disparate regulation?
I suppose we just respond to the requirements that our clients might have. So Some of them might be in a jurisdiction that requires them to actually store the private key in that jurisdiction if they have any client funds. So we're able to implement our solution with that in mind, whether that's on-premise or cloud-based, to make sure that the private key never leaves that jurisdiction. We're also able to do things like optional HSM deployments, so hardware safety module. Some clients require that, some don't. It's actually interesting because I think people are getting a bit more educated on that subject, but in the past, some of the questions we were getting, well, we have an HSM, why do we need something that protects us from cybersecurity attacks? And HSM really just protects your private key from physical attacks. But I don't actually need to extract your private key in order to direct your funds to a different address. And that's how the company was founded. They did just that. All you need to do is attack and replace an addressee, for example, a recipient in the transaction that's being formed, and that those funds will go elsewhere. So I suppose we just make sure that we work with clients side by side, and that using the GK8 solution, they're able to comply to any regulation that they might have in their jurisdiction.
Same question to you, Christopher, around regulation.
Yeah, so I mean, we're a US firm that's now more expanding into Europe. We've always been fully regulated, FCA regulated, but my personal stance is that the SEC is slowly softening up. I mean, we've seen that with the ruling in the XRP Ripple case. With the forthcoming ETP approvals, I think we're moving in the right direction. But luckily, there's also a world outside of the US. And to Manuel's point, I'm being European-based or being UK-based, but with Europe being our key market, I'm very excited about MiCA. I think that we've always played by the book is probably one of the reasons why we're still around. 2022 was hard for the entire industry, and we're slowly rebuilding the trust that was broken. And regulation will play a key part. So I think the right initiatives are being made. It's slow, maybe too slow for some, but I'm actually very optimistic about what lies ahead.
And same question, Eliza, how do you navigate that, especially in the US?
Yeah, sure. So interestingly for us, we started the business in Switzerland. Our founders, Henny Hashwan and Ophelia Snyder, looked at more than 20 different jurisdictions before actually launching the company back in 2017. And Switzerland has been actually the most crypto-friendly jurisdiction to actually launch exchange-traded products at that time. And it still is. And across Europe as well, then we can passport the ETPs. But for us, when we have questions about regulation, is really for the underlying assets than actually for the typical issuers. And for the underlying assets, it's very clear for Bitcoin, but I think for the long tail, this is still a question mark in the US. While in other jurisdictions, we're seeing a lot of regulators trying to embrace the asset class, for example, like in Hong Kong, exposing now digital assets through exchange-traded products with futures. So we're seeing more and more, I would say, interest and education from the regulators across the world, actually, to understand better the asset class, from the CFTC, from over regulators as well. So I think that's really the exciting part. But I think what we're going to see in the coming year is the fruition of many bills that are coming in the US. And I think that would give more clarity as well for the asset class.
And Christopher, you're nodding, and you also touched on the Bitcoin ETF, or the excitement around the possibility of a Bitcoin ETF.
Yes.
What do you make of that? Do you think that an approval would open the floodgates to adoption? Yeah.
No, thanks, Nico. I'm personally very excited about the ETFs, the ETPs, however you want to define the products, the approval in the US. I mean, we saw on Monday with the fake news coming out, the market spike that caused, which shows two things. The lack of liquidity still in the market, but also gave us a taste of what is to come once these products. And I'm really, I want to say when, not if, because I'm convinced that they will. And it's a wrapper that institutions are familiar with. I want to come back to the point that, we all know here how to navigate a wallet and how to do crypto transactions. Institutions, just by buying an ETF, they don't have to do that. And that's familiarity, it's security. And so to answer your question, yeah, I'm really excited about it.
Manuel, I'm afraid I have to put the same question to you because I know Fidelity is in this race.
Yeah, so I because Fidelity has an ongoing filing, I can't comment on the US ETF directly. What I can say, I agree with Christopher's sentiment around, the familiarity of certain wrappers, right? And so, it's no secret, like Fidelity has got, various Fidelity asset management arms have got other products in market in other parts of the world. And it's no secret that we think, different investors will have different ways of accessing the market, and it's important for those access points to be sort of open in a well regulated way, right? Whether there's huge amounts of liquidity waiting to kind of pour into the market, I think there's different factors, including sort of macroeconomic conditions, etc. And we have a lot of research around what some of those factors are. So it's difficult to tell. I certainly wouldn't want to speculate on price, etc. But as thinking about long term, having good market access points is a very important thing, and so that would be a positive development in that sense.
We're slowly running out of time, so I guess my final brief question is what you each think it will take for mainstream adoption of crypto, for the floodgates to open, whether that's regulation, whether it's the Bitcoin ETF, for crypto to be accepted widely as a mainstream asset class. Manuel?
So we have some data on this. So I try and go back to that. Otherwise, like we're all personally biased. I'm certainly very biased because I work in this space, right? But what the data tells us that we typically run this study. We have run this study once a year, and we get an independent company to come in and survey. Not all of our investors, but globally survey in excess of 1,000 investors. So it's a pretty wide range, all the way from family offices to sort of defined benefit plans and that kind of thing. And it goes back to that barrier component. So on the sort of positive of like what makes you come into the space is the kind of disruptive technology play, the lack of correlation. Although in 2022 that dropped off somewhat. So those are sort of the two main bits. Most investors, like by some margin, most investors that we survey think that digital assets are appealing. And if they look at it in sort of the 3-year time period, I think that goes up like 90-something% of investors think that they have a place in a portfolio. But then they also tell us why they don't have it in their portfolio yet, right? Or are the barriers for either new investment or further investment. And there's some work to do, right? Like some of it is volatility, and actually I think volatility kind of goes away with institutional adoption over the long term. But there are things like fundamentals. So security clearly still a hot topic. We probably thought as an industry in 2021 that we were kind of done with it, and clearly the market events of 2022 showed that there wasn't that level of maturity necessarily. And then other sort of institutionalization issues. I think valuations, as Eliza was mentioning, is a big one. A lot of investors and their research teams haven't quite trained up to be able to evaluate these assets and build sort of pricing models around them and that kind of thing. So it is those kind of barriers of regulatory environment, institutionalization, and maturation of the asset class. And I think as those drop off, then more and more investors start coming in.
Great. Yeah, Eliza, very briefly, what will it take?
I think for digital assets or crypto assets, I think there are two ways to think about how to reach mainstream adoption. We haven't crossed the chasm yet, and I think for the investable assets, so Bitcoin, Ethereum, and the long tail, is really providing an easy access to the asset class through, of course, exchange-traded products or any other type of regulated exchanges where people can have access to the asset class more easily and safely as well. And then for the technology itself, we have a long way actually to cross the chasm. For us, the way we actually describe the stage at which we are for digital assets is actually like in the early 1990s, where we had the web pages loading for like 5 minutes or taking hours to send an email. Today, to transact on the Ethereum network, it takes 50 transactions per second, right? Compared to the Visa network for 2,000 transactions per second, we are not there yet for having that scalability that can compete against against payment networks. But there is a lot of technologies out there that are super exciting. So I would say, to summarize, for the technology, we need more scalability, interoperability, cybersecurity, and easy user interfaces as well, because some of them are honestly to some extent hilarious to see. So we're quite excited to see more and more innovation on that front for the technology.
Anya, what will it take?
Well, I agree with Manuel. We need to go at least 6 to 12 months without any hacks. So that would help quite a bit. And most hacks occur because a private key is exposed. So we need to protect against that. And then on the other side, it's not all about like crypto assets like Bitcoin, Ethereum. We've seen clients interested in issuing stablecoins. And I think there is a demand for a stablecoin that's issued by a regulated bank, issued securely and safely, and is made available to everyone. I think that will facilitate global adoption quite a bit, as well as tokenized real-world assets, bonds, money markets, real estate.
And Christopher, your point of view?
Yeah, I think there's two elements. Mainstream adoption comes back to crypto use cases. So, you know, if you go to Turkey, you can pay at a supermarket in Bitcoin, at a coffee shop, in a toy store. The other thing is store value. If you live in Argentina right now, you know, the Bitcoin denominated in peso is at an all-time high. So store value is still a key factor. But for financial institutions, and that's what we're talking about here today, adopting crypto, we can't get around regulation. So for me, that's key. Just quickly to Anya's point, you know, cash on chain. There was a brilliant panel on earlier today with, you know, for the largest European and US asset managers managing trillions, experimenting with tokenization. So I think, you know, there's a lot more happening behind the scenes that we may know of. So I'm extremely optimistic around answering the question with a strong yes. Financial institutions are adopting crypto.
Optimism is always a good thing. Well, thank you so much. I'm afraid we've sort of run out of time. Thank you to my panel and thank you all for joining us. Enjoy the rest of the day.